Uh, Hello, welcome back to the continuing lecture in tax computation. This is Dr. Jeff Hong, and this is the fourth video in the same topic. Now, in our previous video, we talked about how the corporate tax computation is different from personal income tax. And the idea is very simple. You find your taxable income. So I made a slight change to make the table a little more organized and less complicated. I made a slight change to this column B. I mean, I had it over column B and C, but unlike I combined taxable dividend into in column B, so that they would be all EBIT and dividend, taxable dividend would be all in a single column. Everything would be in single column. And the reason for that is, unlike the personal income tax, and in the personal income tax, dividend is taxed separately, right? Dividend is taxed separately from the earned income. So dividend is taxed at all 15%, as long as you are above like 25% tax marginal, if your marginal tax rate is above 25%, and below 25%, you pay zero, nothing on. And again, after 2018, because the income tax bracket has changed, and there's no more 25% bracket, but 24, and dividend income is taxed at 12%, not 15%. So we just need to make some adjustment for that. Otherwise, it's basically the same rule. But in corporate tax, the dividend is not taxed at a separate rate. Dividend is all lumped up together with the taxable income, so with the rest of the corporate income. So EBIT plus taxable dividend is this, and you just subtract the interest, and you arrive at EBT. And the EBT is, of course, your taxable income. Okay, and then I already filled in this, but the point is we are gonna have to use a model or formula that would apply, that can be reapplied over and over under any circumstances, right? Not just for this, because in our example, our taxable income is above 23 million. So just by looking up, you can find, because it's in this range, you would do this. But we should be, the model, this Excel model should be applicable under whatever taxable income it may be. It could be 5 million, it could be 16 point something million. No matter where it is, we want Excel to automatically find the relevant rate, and us just calculate the tax for that bracket, and the rest of the brackets would automatically be 0. So how do I do that? So here, this is how I did. Maybe so the point is we have to check if our taxable income falls between this, the lower bound, and upper bound. And how do you do that? I mean, we need to use if command, but remember, if command is like one way. If x is greater than y or less than y, that's it. So what do you do if question is if x is greater than y but less than z? Okay, how do you handle something like that, right? Okay, so how do you handle uh, uh, second, how to do how do you encode, how do you code this type of if condition? Well, we can handle it by using if and. Okay, what does that mean? If and means, so take a look at this. So in if command, inside the first parenthesis, you put and that should satisfy two conditions. And means, conjunction, so it should satisfy conjunctively two conditions. One is, first, our B12, which is our taxable income, right? B12 is our taxable income, right? If our B12 is greater than A20, and at the same time, if our B12 is less than B21. Now, why is it A21? Why is it A20? Shouldn't it be C20? Um, no. The reason being, originally, look at this inequality sign. I mean, of course, our income should be greater than 0, right? To pay taxes, right? 0, it's irrelevant, right? Uh, so starting from any positive income, but our upper bound is 50K. In other words, our upper bound includes 50K. That's why it is greater than or equal to 50K. All right. But then how do we incorporate, how do we express that greater than or equal to? Actually, no command can, there's no symbol that you can put into Excel to make this possible. So then what do? Instead, you would make the upper bound greater than $1 greater than this. Then 50K up will be included in the upper bound. Makes sense? But 50K and $1 won't be included. Right? Clever, isn't it? So that way, everything up to 50K is included. And then If it satisfies that condition, that means if this satisfies, then what do? Minimum, the lesser of the two, right? Lesser of the two between. Uh, so think about it. If our income is taxable income is, in other words, B12 is like 45K, then it satisfies this, right? And then between the 45K and 50K, 45K will be lesser, right, of the two. So then uh, you would incorporate income tax. You pay this uh, like a base. I call it base amount, but then it can be misleading. It can be so this because base is the lower bound. Base is actually lower bound. So pay this amount on the base. That means on the lower bound. So for each bracket, there is a certain fixed amount you have to pay, and then above the difference between whatever is less, right, between the two and the lower bound, right? In this case, is 0. But from the second row, second bracket, it will make sense. Take the difference between the lesser of the two, and in this case, it's not gonna kick in because our EBT doesn't even fall into this, right, into this range. But if it is like 45K, it will fall into and the difference between the lower bound and the minimum of the two will be taxed at 15%, right? That's what it is saying. The lesser of the two minus the lower bound, right? So that's the difference. It will be multiplied by 15% plus this fixed amount. And if it falls into this, you do that. If it doesn't fall into this range, then 0. Nothing applies in this range. Now, and so it automatically puts 0 there. And if you drag it down through and through, it will automatically pick, it will automatically find, so what is, applicable. So in the second row, take a look. In the second row, second bracket, 25% bracket. If it falls within this bracket, so that's, greater than this, right? If our B12 is greater than this and less than greater than this and less than this at the same time, right? Then take the difference, right? Take the difference of the minimum of our taxable income and 821. And of course, our taxable income is greater than this, so this is not going to kick in. But what if our taxable income is exactly between, something like, 60K? Then, right, it would fall into this range. And then you take the lesser of the two, minimum of the two, and take the difference between that amount and the base amount, the lower bound, and taxed at 25%, and you add it to this fixed amount. Okay, and then you do that through and through. You will do it through and through by copying and pasting it all the way down. And since they all don't, our taxable income is this, it doesn't apply to any of these brackets, but it applies to this bracket. So it's going to automatically click in this bracket. An interesting thing is because in this bracket, it's not between two values, two parameters. In other words, it's not between the lower bound and upper bound. It's only above the lower bound. So for this only, we will need to make adjustment. Okay. Excuse me a second. And so only for the, because this is the last bracket, right? Only for the last bracket, you make it, and is not even necessary here, right? But it doesn't hurt. It's innocuous, so I leave it there. But since this is just one way, and is not necessary. So if our taxable income is greater than the lower bound, then we simply take the difference between the our taxable income and the lower bound and multiply that by 35% and add it to the fixed rate, fixed amount, right? Otherwise, zero. Zero won't kick in, right? Anyway, this will kick in, right? So automatically. So that's what we got. Okay, so that is 8.162. So our total tax is 8.162 million, right? It's called also tax liability, of course, because that's what you owe the IRS. So it's a liability, right, to IRS, not onto the creditors, liability, not the liability to the creditors, but liability to IRS, to the government. So our question is, use the tax schedule and calculate Dakota's income tax liability. What are Dakota's average and marginal tax rates on taxable income? So we know what average tax rate is. So now we divide this by our taxable income, which is in B12. We get, right, 35%, right? And we were anyway in 35% tax bracket, right? And then our marginal tax rate is, you get the idea. If we make one more dollar, right, incremental, right? Marginal means incremental, right? Marginally incremental, right? If you make one more dollar, are we going to fall into the next, are we going to cross over the threshold? Are we going to exceed? Are we going to cross over to the next tax bracket? But of course, there's no next tax bracket. This is the last tax bracket. So no matter what, our marginal tax rate will still be 35%. But logically, you can give Excel the command, right, to automatically find it. Now, so this is the example of how you can do the corporate income tax. So our next question is, I'm gonna stop sharing this Excel file and switch back to our PowerPoint, right? So, and there you go. So everyone can see this PowerPoint. Okay. So yeah, I'm sure you can see that. So then our question is, we did this because, mainly from corporate perspective, from, not from individuals' perspective, but, because this is part of the corporate finance course, right? Is there any benefit in and this is also discussed in the leverage and capital structure and leverage. Is there any benefit in tax if we in different types of funding source? In other words, if we use debt financing, remember from the balance sheet, we all understand what capital structure means. Capital structure is basically about how what is the composition of the capital component. Capital components mean either equity or debt. And interesting thing is, you may think, and I also mentioned this when we did, balance sheet. I briefly mentioned, there is a optimal capital structure. 100% equity financed company, is not good necessarily, right? It may be very safe because there's no default risk, right? And if the company stocks lose value, I mean, basically, stockholders are owners. Owners will, have nobody to blame but themselves, the risk, in other words, the stockholders take the risk, but at least you owe nothing to nobody because there's no debt. But I've been telling you, there's a reason why they called using debt leverage, right? And the optimal capital structure is not necessarily 100% equity, but something like 30% debt, 70% equity, or 60% equity, 40% debt, right? That would be most companies. Most companies would find optimal capital structure somewhere between, like 60% equity, 70%, 60% equity, and 70% equity, which means 40% debt and 30% debt, right? So in other words, using debt has advantage, especially it is quite obvious in when it comes to taxation. So, and a simple example, let's take a look at this. So, assume two firms, right? Okay, two firms, one company, right? Uh, if the firm, this may be the same company, right? I think this example shows the same company, but two different capital structures. One, uh, they use, some debt, but in next scenario, they don't use any debt. If they don't use any debt, then interest will be zero, right? And they use some debt, right? Uh, this company has some debt. What did I do? And this company has all equity, right? Two companies, one company with some debt, the other company with all equity, right? Then let's take a look at the all equity company, right? 100% equity. Their EBIT is 120, let's say million. Interest, they don't pay any interest because they don't have any debt. Then their EBT will be 120. And if the tax rate is 30%, 30% of this will be 36 million, right? And if everything is in million, right? And then EAT will be 84. Uh, and in this company, and then if they are paying dividends and they pay out, uh, you know, $20 million in dividends, their retained earnings, which is a additional equity, you remember that, the retained earnings will be 64 million in this case. But don't even look at the dividends and retained earnings. This company is using debt, some debt, so they pay interest, and after paying interest, this is their taxable income or EBT. Tax 30%, 30%. EAT would be 70, right? And let's say they are not paying any dividend, um, then their retained earnings would be 70. Of course, they may pay dividends. If under a dividend paying scenario, this would be different. But again, if we this doesn't have any balance sheet, so we don't know how much equity they have. But when we calculate, our question is, uh, when we calculate return on equity, right? Right? Usually, this company with some debt will win out. Usually, right? The case in terms of return on equity. But this isn't that detailed, right? This example isn't that specific. Um, but in the topic, in the future topic, like uh, capital structure and leverage, this will be uh, discussed, in more detail, right? And you will see drastically the benefit of leverage. And this is what we talked about, depending on and the double taxation is always, double taxation is always, brought up when what I'm, but what does that mean? If company A, corporation A, has shares in corporation B, and corporation B pays dividend to A, right? Then think about it. Before paying the dividend, corporation B has already paid tax on their income. In other words, dividend is something that happens after paying tax. So dividend is part of, the EA, which is, after tax result, right? So this dividend is part of the profit that is already after tax. So that means the dividend that B pays to A is already taxed, right? This is already taxed. Already from B. And then when corporation A pays dividend to shareholders, and this dividend from B to A is part of the corporate income, right? Corporate A's income. Corporate A also pays tax on they pay tax on their income, which includes already, okay. So then when the shareholders get the dividend, then they are taxed again. Okay. Now you see why, oops, I'm sorry. See, now you see why it's called, multiple taxation. So actually, even if, think about it, let's say there is no dividend from corporation B, but purely from corporation A to shareholders, there's already inevitably double taxation, right? So that's why there's a reason for um, applying like low tax rate on dividend income, right? Because it has been taxed already on multiple levels, right? But again, theoretically it is so, but it's still the fact still remains that Warren Buffett pays at a lower rate than his secretary. Now, tax laws carry back and carry forward, right? Usually, if you have no EBT, in other words, no earnings before taxes, uh, that means you have no taxable income. If your company hasn't done well, right, you won't have any, after paying interest, you won't have any taxable income left. Or you may not be even able to pay interest. And in that case, and the company actually ended up with, net loss. Of course, if you end up with net loss, then, for the loss, business losses can be carried backward 2 years back, right, or forward 20 years max in time, right, to offset taxes that might otherwise be excessive. I mean, yeah. So for 1 year, right, I mean, you had no taxes for the look, EBT, year one, year two, year three, year four, um, year one and two, you have uh, you paid taxes and you had positive uh, net profit. Year three, you had bad year and EBT is already negative, then you pay no taxes. And your EAT is negative. Year four, okay, you had good. Year five, you had EBT, but you paid. Is this possible to pay? When your EBT is 50, paying 90 dollars, $90 million for taxes. But if that is the case anyway, EAT is negative 40. Now, this loss in year three can be carried back like 2 years, right? Spread over, right? Oh no, this is not. This is just total. I'm sorry. This is not the year five. I thought it was year five. So you spread it over 2 years back and up to 20 years forward, and then offset taxes in the previous 2 years. Okay, so and then okay, forward. Reduce your reduce your EBT by 50 million, and then your tax will be lowered to 15 million, right? Uh, so this is the conclusion of the taxation, and I believe this has been like another 40-minute video. So, but that concludes our this lecture in this topic. All right. Thank you for watching, and I'll see you guys in the next lecture. Stop recording.